Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. So gold has actually been stuck in a range over the past week. The FOMC meeting's dot plot, which cut down the expected rate cuts for this year, the stronger than expected U.S. industrial production report, and the PBOC pausing its gold purchases have all created headwinds for gold. However, cooling U.S. CPI data, lower than expected retail sales, and escalating political tensions in Europe have supported gold prices. With the market lacking new catalysts, traders should keep an eye on Friday's S&P U.S. manufacturing and services PMI data, as well as next week's U.S. PCE data. So looking at gold against US dollar daily chart, after briefly dipping below $2,300 last week, prices have been fluctuating between $2,300 and $2,330 with a slight upward trend overall. The $2,330 level, which was tested multiple times as support from late May to early June, has now turned into resistance and is proving to be a key level again. If the bullish momentum continues, the next level to watch is the May high of $2,360, while on the downside, if the bears take over, the $2,300 and the late April and early June low of $2,285 could see some buy the dip action. So gold is currently in a bit of a stalemate between bulls and bears. Last week's cooling May US CPI data gave the market more confidence in the first rate cut this year, which is good for gold, obviously. But the Fed's latest dot plot indicated the reduced rate cuts for this year from 3 times to only once, and slightly raised the PCE inflation forecast for this year and next to 2.8% and 2.3% respectively. This higher for longer stance has lowered market expectations for cuts this year, making gold less attractive. Additionally, yesterday's U.S. industrial production for May showed a 0.9% increase, much better than expected, but the data for March and April were revised down, and the retail sales came in below consensus. With cooling U.S. inflation and the hawkish adjustments in the dot plot, this creates mixed signals, leading the market to adopt a cautious approach, resulting in limited price fluctuations. Well, globally, political tensions in Europe and the ongoing conflicts in the Middle East have sparked safe haven demand, supporting gold prices. However, the Chinese central bank announced a pause in its gold purchases, the first break after 18 straight months of buying. Personally, I believe central banks' move towards de-dollarization and increasing gold reserves is a long-term strategy. If they can buy gold at better prices, it's a more rational choice, right? So I still see the central banks increasing their gold reserves as a major trend, but the PBOC's temporary pause may cause gold prices to lose some support in the short term. So overall, gold prices have been range-bound with mixed signals from both bulls and bears. Traders are taking a wait-and-see approach until new catalysts emerge. For the rest of this week, Friday's S&P U.S. manufacturing and services PMI data are worth watching. The market expects both indices to remain in the expansion zone, but slightly lower than the previous values. If the data falls below consensus or even below 50, the market might see a greater need for Fed rate cuts, providing a short-term boost to gold. But I believe more importantly, next Friday's US PCE inflation data could guide the trend in gold prices. The US CPI has dropped for the past 2 months, and April's PCE inflation showed signs of cooling down as well. So if this core PCE month-on-month growth in May is lower than April's 0.2%, it might convince the Fed to lean more towards rate cuts, giving gold prices a boost. So that's pretty much for this week. If you have any thoughts on potential catalysts for gold or recent gold trading in general, feel free to leave a comment below and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!